Ladies and gentlemen, the first half of this year has brought higher US tariffs and lower taxes as promised by US President Trump. They came with the political uncertainty that we feared, but not the peace agreements in Ukraine or the Middle East that we hoped for. Overall, the global economy and financial markets remained remarkably resilient. Only the US dollar depreciated sharply. Let's dive into the economic consequences of these developments, into central bank strategies, and into our equity market outlook for the second half of this year. I start with the economic perspectives. First, exports to the US are likely to fall as US companies have stockpiled foreign inputs ahead of higher tariffs, and the cheaper US dollar has reduced the competitiveness of foreign exporters. This should support US growth, but weigh on its trading partners in the summer months. Second, policy uncertainty, tariffs, and the weaponization of the US dollar will induce further countries to diversify their foreign reserves into gold and other currencies. Internationally active companies may also put some of their investment plans on hold until it becomes clearer what their cost base will be in different locations. And third, European countries are massively increasing their defense spending in response to the ongoing wars and the potential security threats. NATO members have agreed to ramp up core defense spending up to 3.5% of GDP by 2035, a ratio that Germany wants to achieve by 2029 already. Spending on defense-related infrastructure is planned additionally. As a result, fiscal deficits and debt levels will increase in Europe, but so will economic growth from 2026 onwards. China will also do its part to strengthen its domestic market, as exports to the US are sure to fall. Let's turn to central banks. They are clearly in a more comfortable position than a year ago, as inflation rates have fallen back to the 2% target like in the euro area, or have moved closer to it like in the US. We expect 2 rate cuts by 25 basis points until the end of the year, both from the European Central Bank and the Fed. The Fed may wait until late summer before it resumes its rate-cutting cycle to see first whether higher tariffs and the lower dollar show up in higher prices. In contrast, we expect no further cuts from the Swiss National Bank, as its policy rate has already reached 0% and we see no reason for negative rates again. Ladies and gentlemen, we remain concerned about the unsustainable debt dynamics in the US and in some other countries. Yet the perspective of lower policy rates should prevent bond yields from rising materially in the coming quarters. Finally, we note that equity markets have fully recovered their trade war-related losses, with US equity valuations reaching new multi-year highs. As recession risks have receded, we also see no reason to underweight equities in the current environment. Yet we are afraid that a bit too much optimism may be priced in, and we expect the upside in the US to be limited in the short term. In contrast, European equities are looking more attractive again. With growth in Europe likely to pick up in coming quarters, European equities could once again outpace US equities in the coming months. In summary, we remain optimistic for the remainder of 2025, favoring European over US equities and gold over the US dollar. Ladies and gentlemen, thank you for your interest. I wish you a nice summer break and a successful second half of the year.